So the next topic is actually a part of capital gains, okay, but it is connected with non-resident and hence we are discussing it under chapter NR taxation. So basically it is called as first proviso to section 48. While computing capital gain, there are certain things that you have to be careful. That's what we are about to discuss right now. Yeah. So whenever we compute capital gain, there are certain things that you have to be careful about. That's what we are about to discuss right now. Tell me friends, how do you compute capital gain? What is the format for computing capital gain? What is the format for computing capital gain? We always start with the full value consideration. Full value consideration. Then we will deduct direct expenses. Direct expenses on transfer. Then you will get net sale consideration. If you deduct full value consideration, if you deduct direct expenses from FVC, you will get net sale consideration. From that, you can deduct cost of acquisition as well as cost of improvement. Then you will get the capital gain. Whether it is short term or long term depends upon the period of holding. This is how you normally compute the capital gain. Yes or no? But what department says, if you are a non-resident or a foreign company and you are purchasing shares or debentures, and you are purchasing what? Shares or debentures in foreign currency. You have purchased what? Either shares or debentures in foreign currency. You are a non-resident or a foreign company and you have actually purchased shares or debentures in foreign currency, and now you are selling that particular shares or debentures. Now you are what? Selling that particular shares or debentures. When you are selling that particular shares or debentures, we need to compute what? Capital gain. While computing capital gain, there can be one problem. What is that problem? There can be a foreign exchange fluctuation. Yes or no? To accommodate that foreign exchange fluctuation, they are telling you to compute the capital gain in accordance with first proviso to section 48. To accommodate that foreign exchange fluctuation, you need to compute the capital gain in accordance with first proviso to section 48. Let's understand how do we consider that. So applies when a non-resident or a foreign company has taxable income from capital gains on account of transfer of a share or a debenture of an Indian company which is purchased in foreign currency. If you have share or debenture of an Indian company which is initially purchased in foreign currency and you are selling that particular share or debenture and you are a non-resident or a foreign company, when you compute capital gain, you must follow first proviso to section 48. Now the question is, what is this first proviso to section 48? The procedure is as follows. What they are saying is, as step number 1, you compute the sale consideration. That means the full value consideration. Find sale consideration in Indian currency, convert it into foreign currency. If the full value consideration in the question is in Indian rupees, you need to convert it into foreign currency. You need to convert it into what? Foreign currency. For converting it into foreign currency, you require a rate of conversion. Yes or no? So let's understand how do we convert it. What they are saying is the average exchange rate as on date of transfer. You take the average exchange rate. 2-3 questions are there. Question number 1. To which foreign currency we do have to convert that full value consideration? You have purchased that share or debenture in some foreign currency. If it is dollar, then you convert the sales value into dollar. If it is yen, you convert it into yen. If it is euro, you convert it into euro. If it is sterling, then to sterling. So whatever the foreign currency that you have utilized to purchase that share or debenture, to that foreign currency you convert. For conversion, you require a rate of conversion. What should be the rate? They are saying average exchange rate as on date of transfer. Now the question is, what is this average exchange rate? Every day there will be a buying rate and selling rate. You might have studied this in your AFM or SFM. And every day there will be a buying rate and a selling rate. What is buying rate? The bid rate. That means the rate at which the bank buys that particular currency is said to be the bid rate. And what is the ask rate? The bank will ask. That means the rate at which the bank will sell that particular currency to the customers is said to be the ask rate. So there will be bidding rate or asking rate, or bid rate or ask rate, or buying rate or selling rate. Normally they will show it as like this, 10 bar 11. 10 bar 11 means what? 10 is the bid rate and 11 is the ask rate. This won't be 1 rupee and all, but normally the lower figure will be the bid rate and the higher figure will be the ask rate. Now you take the average of these two. So that is what this explanation is all about. Telegraphic transfer buying rate or selling rate is the rate of exchange adopted by the State Bank of India for purchasing and selling. You take the average on the date of transfer, average exchange rate. What is average exchange rate? You take the average of TTBR and TTSR. What is TTBR? Telegraphic transfer buying rate notified by State Bank of India. What is TTSR? Telegraphic transfer selling rate notified by the State Bank of India. So you take the average of TTBR plus TTSR divided by 2. TTBR plus TTSR divided by 2, you will get the average exchange rate as on date of transfer. Are you with me? So you compute the average exchange rate as on date of transfer, then you convert that full value consideration into Indian rupees. This is number 1. Not yet over. Step number 2. There can be direct expenses on transfer. Yes or no? The direct expenses of transfer also, find the expenditure on transfer in Indian currency and convert it into foreign currency. If that is given in Indian rupee, then you convert it into foreign currency. Which foreign currency? See, at the average exchange rate as on date of transfer, not on the date when expenditure is incurred. What is that? See, today is the transfer. Only after 1 week you are paying the brokerage. Today is the day you sold the share and only after 1 week you paid the brokerage. Then you tell me on which day's average exchange rate you have to consider? Today. Date of transfer is the one which is relevant. Date of expenditure is irrelevant over there. Are you with me? So when you are converting direct expenses to foreign currency, always consider the average exchange rate as on date of transfer, not on date of expenditure. Are you with me? Now, you will be having cost of acquisition. If that is given in Indian rupee, convert that also into foreign currency. On what rate? Average exchange rate as on date of acquisition. That means date of purchase. You need to convert the cost of acquisition also into average exchange rate as on date of purchase. There won't be any cost of improvement. For share and debenture, will there be any cost of improvement? Will you paint share and debenture? No. Will you construct any fencing for share and debenture? No. So for shares and debentures, there won't be any cost of improvement, and hence we don't have to think about cost of improvement. Cost of acquisition, you need to convert it into foreign currency based on the average exchange rate as on date of purchase. Now you got everything in foreign currency. You compute the capital gain, that will be in foreign currency. Step 1 minus step 2 minus step 3, that will be capital gain. That will be in foreign currency. Now, can you pay taxes in foreign currency? No. So that you need to reconvert everything to Indian rupee. So what they are saying is taxable capital gain, so calculated in step 4, will be reconverted to Indian currency. For reconversion, you require a rate. Yes or no? What should be the rate? The buying rate as on date of transfer. The buying rate as on date of transfer, not average rate. Buying rate. It is basically beneficial for the assessing. Because even if you transfer it, ultimately in rupee, you will only get that buying rate. So department say only show that buying rate as your capital gain and pay the taxes. If the number of shares is huge, then it can bring a huge difference. For 10 shares, 20 shares and all, it won't be much big, but it is actually beneficial for the assessee. So that automatically that foreign exchange fluctuation will get automatically adjusted in this math. Are you with me? So this is actually a procedure to compute capital gain. If you are an NR or a foreign company purchasing shares or debentures of an Indian company in foreign currency and you're selling it outside, then what do you need to do? You need to compute everything in Indian rupee and convert it to foreign currency and compute the long-term capital gain or short-term capital gain, whatever it is in foreign currency, then you reconvert it into Indian rupee. That's what they are saying. I hope it is clear. Not yet over. There are certain notes, support notes we can say in relation to this. Note number 1. The asset may be short-term or long-term capital asset. Asset can be short-term, asset can be long-term. Doesn't matter. You must follow this procedure. Second one, the first proviso to section 48 is not applicable to units of UTI and mutual fund. Obviously, only for shares and debentures this provision will be applicable. You don't have to convert or reconvert the capital gain on transfer of mutual funds as well as UTI units. Then, benefit of indexation shall not be available in the case of the above transfer. While doing the above transfer, you cannot claim the benefit of indexation. Not permissible. You are not supposed to claim the benefit of indexation in such circumstances. Then, first proviso to section 48 would not be applicable to the capital gain referred under 112A or 111A. That means if the shares are listed shares or listed, only listed shares, then the computation will be under section 112A if it is long. If it is short, under 111A. In such cases, don't follow or don't do this conversion, reconversion process. Rather, you can compute the capital gain according with 112A and 111A itself. And the method is not optional, it is mandatory. Whether you want to opt it or not, we are not giving you a choice. You have to mandatorily follow this option. Are you with me? Are you all here? So this is what they are saying as a part of first proviso to section 48. Now friends, listen. There are a few notes in relation to this. Note number 1. Debentures, whether listed or not listed, of an Indian company are only covered under this proviso. However, bonds of central government, state government and RBI bonds are etc. not covered for this purpose. Debenture is whether listed or unlisted. If it is purchased in foreign currency, you have to follow first proviso to section 48. For shares, if it is listed, follow 112A or 111A. If it is a central government or a state government and RBI bond, you don't have to follow first proviso to section 48 because it is applicable only for debentures as well as shares. Note 2. Non-corporate, non-resident or a foreign company to be subjected to tax at a concessional rate of 10% bar 12.5% without indexation benefit, that is second proviso or currency fluctuation, that is first proviso, on long-term capital gain arising from transfer of unlisted securities or shares of a private limited company. So listen, from 23rd July 2024, this provision does not have any much purpose to serve. But before 23rd July 2024, what is the relevance of 23rd July 2024? 23rd July 2024 is a effective day where the central government have revamped the entire capital gain rates, structure, etc. Okay, before that date, you tell me, if you are transferring a unlisted share of a private limited company or an unlisted security of private limited company, the rate of long-term capital gain was under section 112 at 20%. Are you with me? So, before amendment, under section 112, long-term capital gains are taxed at 20% subjected to indexation. Are you all here? We'll be having a detailed discussion on capital gains. But for the time being, just listen here. At that time, there was an option for this non-residents and foreign companies. This NRs or foreign company, if they are transferring shares of a private limited company, or if they are transferring securities of a private limited company, they do have an option. What was that option? If they give up indexation, there is a section called section 112 subsection 1 clause number C. According to section 112 subsection 1 clause number C, if they give up indexation, their rate of tax will be only at 10%. This was there on before 23rd July 2024. This was the old provision. Are you with me? With effect from 23rd July 2024, government changed everything. With effect from 23rd July 2024, nobody can claim indexation benefit except for certain persons, individuals and HUF being resident, they sell land or building, they can. That we will cover in capital gain. For the time being, non-residents anyways, after 23rd July 2024 cannot claim any indexation benefit. Are you with me? So non-residents, whether it is 112 subsection 1 clause number C, the rate of tax is 12.5 percentage. That too without indexation. That's what I told you. From 23rd July 2024, this 112 subsection 1 clause number C does not have much of a purpose to serve. Anyways, the rate is 12.5%. Anyways, you will not get any indexation benefit. Whether you transfer shares of public company, whether you transfer shares of private company, doesn't make any difference. Are you with me? So don't confuse with everything. Always learn the latest things. Always learn the latest amendments, because that is what is more important for us. So, what is the existing provision? Very simple. Under section 112, subsection 1, clause number C, if you are transferring private company shares or private company debentures or private company securities, under section 112, subsection 1, clause number C, the rate is 12.5. That too without indexation. If you want to opt 112, there also the rate is 12.5 without indexation. Are you with me? So what I have written over here is non-resident, non-corporate or foreign company to be subjected to tax at concessional rate of 10% or 12.5% if the transfer is on or after 23rd July 2024 without indexation benefit. That is second proviso, or currency fluctuation, that is first proviso. So what 112 subsection 1 clause number C, what you can say is, if the assessee is want to opt for 112 subsection 1 clause number C, that too after 23rd July 2024, their rate of tax will be 12.5 percentage. Plus, you can ignore first as well as second proviso to section 48. What is first proviso? If you opt for 112 subsection 1 clause number C, you don't have to do this conversion, reconversion. Plus, you will not get indexation. Are you with me? So, after 23rd July 2024, if you are being a non-resident or a foreign company, you want to pay taxes under 112 subsection 1 clause number C. For that, you must transfer the shares of a private limited company or securities of a private limited company. If you are opting for 112 subsection 1 clause number C, no change in the rate, it is 12.5% only. But there is one speciality. What is that? First proviso to section 48, you don't have to follow. You can ignore first proviso to section 48. That's what they are saying. These are the two notes under first proviso to section 48. And before we move on to a question, I just want to remind you one more thing. It is something related to 112A. It is not related to first proviso to section 48. It is something related to 112A. Hope you remember, you might have studied it in your inter syllabus, because this is actually required for solving the next question. If you are purchasing a listed share, before or on or before 31st January 2018, there are certain specialities while computing the cost of acquisition. If you are purchasing a listed share before 31st January 2018, while computing the cost of acquisition, what income tax department say? You have two options. Option number 1, you can either take actual purchase cost. Or option number 2, you can take lower of fair market value of the shares as on 31st January 2018 or full value consideration at the time of sale, whichever is lower. You compare these two, pick the lower, either that figure or you can take your actual cost of acquisition, whichever is more beneficial. More beneficial means compare these two and pick the higher, because this is cost. More cost, less gain. Less gain, less tax. So beneficial will be what? Whichever is higher will be the beneficial. So where were we? Very simple. I'll demonstrate this with an example also, okay, if you have any confusion. Say I bought shares of Tata Motors on say 2010, 2011, say for 1000 rupees. On 31st January 2018, the share price is say 1200 rupees. During 24-25, I sold that shares for say 5000 rupees. How do you compute the capital gain? Full value consideration 5000. Imagine there is no direct expenses, etc. Directly cost of acquisition. When you compute cost of acquisition, since it is purchased before 31st January 2018, while taking the cost of acquisition, you can either take original purchase cost. How much is original purchase cost? 1000 rupees. Or you can take the lower of. Fair market value as on 31st January 2018 is 1200. So FMV is 1200. Or you can take the full value consideration at the time of sale, that is 5000. This is not 12,000, 1200, okay. Now you tell me, you compare these two and pick the lower. Which is lower? 1200. Then compare this 1200 with the actual cost of acquisition and pick the higher. So you can take the 1200 itself as what? Cost of acquisition. And the remaining 3800 only will be the long-term capital gain. Are you with me? So this has nothing to do with the NR taxation, but the next question we are about to do is has some adjustments in relation to this cost of acquisition computation. Are you all here? Now let's do a fantastic question based on this first proviso to section 48. Let's solve a question. So please take your question number 4. Take question number 4. Read the question thoroughly and give me the answer. Sorry. Question number 4. Let's understand what exactly is this question number 4. Mr. A, a non-resident, remits $40,000 to India on 16/9/2008. The amount is partly utilized on 3/10/2008 for purchasing 10,000 equity shares in A Limited, an Indian company, at a rate of 12 per share. So let me ask you one simple question. Tell me in this question, Mr. A have purchased some shares. Is that in Indian rupee or foreign currency? Is that in Indian rupee or foreign currency? It is foreign currency only. Why? Because the question is very much clear. The amount is partly utilized on 3/10/2008. Means what? You have made use of that $40,000 to purchase shares. At the time of purchase, the rate was 12 per share. Okay, that doesn't mean he purchased it by paying 12 rupee. At the time of purchase, the rate of that share was 12 rupee. That's what the question says. So the purchase is obviously in foreign currency only. And these shares are sold for 48 rupee per share on 3/30/2005, and the fair market value of these shares as on 31st January 2018 was 35 per share. All right. So let's solve it, and they have given some telegraphic buying as well as selling TTBR and TTSR notified by the State Bank of India, and different dates have been given. Compute the capital gain chargeable to tax for assessment year 25-26 on assumption that number 1, these shares are not being sold through a recognized stock exchange. So these are not sold through a recognized stock exchange, and it is of a public limited company. So don't think about section 112 subsection 1 clause number C, because it's not a private limited company. This is a public limited company. A limited means public limited. So what we can do is, let's compute the capital gain. Option A. For that, we require full value consideration first. How much is the full value consideration? They sold the shares for 48 rupees. Yes or no? They sold that particular share for what value? 48 rupee. And tell me how many shares were there? 10,000 shares were there, and sold it for 48 rupees. And let's compute that 10,000 shares into 48 rupee, and how much will be the amount? 4,80,000. 4,80,000 is the amount. Now, you need to convert it into what? Foreign currency. Yes or no? You need to convert it into what, friends? Foreign currency. And how do you convert it into foreign currency? You need to check the date of transfer. Date of transfer is on 30/3/2025. So as on that date, what is the average exchange rate? 59 plus 61 divided by 2 will be obviously 60 rupee per dollar. Are you all here? So when you convert that into foreign currency, you need to divide 4,80,000 divided by 60 rupee per dollar, so that you will get the dollar value. What is the dollar value? $8,000 shall be the full value consideration in foreign currency. The question is actually not talking about any direct expenses on transfer. So there is no direct expenses on transfer. Hence, we can directly compute the cost of acquisition. And tell me, how much is the cost of acquisition as per the question? Cost of acquisition as per the question, they are saying they purchased it for 12 rupee per share. 10,000 shares into 12 rupee per share. So 10,000 share into 12 rupee per share, it will be 1,20,000. That also have to be converted to foreign currency. When is the date of purchase? It is 3/10/2008 only they have purchased that particular share. 3/10/2008, what is the TTBR and TTSR average? It is 20 rupee per dollar. Yes or no? 19 plus 21 divided by 2 will be 20 rupee per dollar. So you can take that 20 rupee per dollar as the denominator, 20 rupee per dollar, so that you will get what? $6,000 shall be the cost of acquisition. Can you claim the benefit of indexation? No, because when you are computing income in accordance with the procedure that is mentioned under first proviso to section 48, you are not supposed to claim the benefit of indexation. So tell me, how much is the gain? $2,000. It is basically LTCG, long term capital gain. Now you need to reconvert this into Indian rupees. While reconverting this into Indian rupee, you need to stick on to the buying rate as on date of transfer. Buying rate as on date of transfer is 59 rupee per dollar. So how do you convert that? $2,000 into 59 rupee per dollar. Don't divide it, okay? Now you have to multiply it. So that will be 1,18,000 rupees. Shall be the taxable LTCG in case number A. I hope it is clear. Yeah, we are about to compute part B now. Okay, part A, I hope it is clear for you. Part B. These shares have been purchased and sold through a recognized stock exchange. These are actually purchased and sold through RSC, recognized stock exchanges. How do you compute the capital gain? Let's see. So when it is purchased and sold through a recognized stock exchange, you don't have to follow first proviso and second proviso. Both indexation you will not get, conversion, reconversion also you don't have to follow. So straight away you can compute the full value consideration. And how much is the full value consideration? It is how many shares? 10,000 shares into 48 rupee. That will be 4,80,000. How about the cost of acquisition, friends? Cost of acquisition is actually it is 12 rupee. But since it is a listed share purchased on 3/10/2008, that means before 31st January 2018, you must apply the special formula. So original cost is 12 rupee. Or you can take the lower of fair market value as on 31st January 2018, and that figure is given in the question, that is 35 rupee, or full value consideration at the time of sale, that is 48 rupee. So these two you pick the lower, that will be 35 rupee, and these two you pick the higher, that will be again 35 rupee into how many shares? 10,000 shares. And the cost will be how much? The cost will be 3,50,000. The cost of acquisition shall be 3,50,000, and you tell me how much is the gain now? 1,30,000 shall be the long-term capital gain. And if they are asking us to compute the tax liability, then Over and above 1,25,000 rupees is only now subjected to 12.5% rate of tax, because there is a change in 112A. Earlier it was over and above 1 lakh at 10. Right now it is over and above 1,25,000 at 12.5%. Hope you remember, we have already covered this in a basic concepts. Okay, so this is how you have to compute the second part of the answer. I hope that also was clear for you. By this we can say we have completed first proviso to section 48, that is the procedure that a person have to follow while computing long term or short term capital gain, provided he is purchasing shares or debentures of a Indian company in foreign currency. All right, superb. Moving on to the next provision, which is again an important provision for us for the examination purpose. It is other special provisions under chapter 12A. We are about to discuss 2-3 sections together. We are about to discuss section 115C, 115D, 115E, 115F, 115G, 115I. So C, D, E, F, G, H I have missed. There is H, okay. H and 115I. C, D, E, F, G, H, I. These are the provisions that are covered under chapter 12A. We are about to discuss this chapter 12A in detail, these sections together. Because these series of sections is actually something related to a common event. These C, D, E, F, G, H, I revolves around a common event, and let's understand what is that event and what is the applicable, what is there in C, D, E, F, G, H, I. Starting with the first one, the provisions of this chapter are applicable to whom? A non-resident Indian who derives investment income from foreign exchange asset or long-term capital gain on transfer of foreign exchange asset. So 2-3 things are there. First of all, you have to be an NRI, not NR, NRI. Plus, you should have investment income or long-term capital gain from what? Foreign exchange asset. If you are satisfying these conditions, then only refer chapter 12A. Otherwise, you don't have to refer chapter 12A. First of all, you have to be whom? NRI. Plus, you should have what? Investment income or long-term capital gain from foreign exchange assets. So, our first duty here is to study the definitions. Who is NRI? What is investment income? What is long-term capital gain? What is foreign exchange asset? This is the first thing that you have to learn. This is what is covered under 115C, definitions. Are you all here? 115C talks about what, friends? Definitions. Who is NRI? What is investment income? What is long-term capital gain? What is foreign exchange asset? Etc. etc. have been provided under 115C, and let's start with 115C first. So the section is all about 115C is all about the definition. So we will start with 115C first. First of all, who is NRI? NRI means an Indian citizen or Indian origin who is not a resident. You are a Indian citizen or Indian origin and currently you are not a resident. Then we can call you as what? NRI. Alright, simple definition. Now the next question is, what is investment income? What will be investment income? Interest and dividend income is said to be what, friends? Investment income. What? Interest and dividend income. Now, what is long-term capital gain? For that, it does not require any definition. Long-term capital gain means when you sell it and the period of holding is more than, right now it is 24 months. Period of holding is more than 24 months, then the asset will become a long-term capital asset and you will be having long-term capital gain. Earlier it was 36 months. Right now they have amended it and make it 24 months as the criteria for determining long-term and short-term. So, long-term capital gain, you know what is long-term capital gain. Now the question is, what is this foreign exchange assets? We are about to discuss what is foreign exchange assets right now. So please listen. Foreign exchange asset simply means, listen, an asset, that means a foreign exchange asset means below assets which is purchased in foreign currency. If you are purchasing the following assets, that too in foreign currency, we can say that you are having foreign exchange assets. Are you with me? We can say specified assets. Specified assets which are purchased in foreign currency is said to be what? Foreign exchange assets. Which all are the specified assets? Let's discuss about specified assets right now. Shares in an Indian company is the first specified asset. If you are purchasing shares in an Indian company, that too by paying foreign currency, and you are an NRI and you are having dividend income or long-term capital gain on account of transfer of that share, you have to refer chapter 12A. Or debentures of a public limited Indian company, or deposits in a public limited Indian company, or any securities of central government, or any other assets notified by the central government. So if you have any of these assets which are purchased in foreign currency, then what we can say, you are having a foreign exchange asset. And you are being an NRI, you are having investment income or long-term capital gain from these set of assets, then you have to refer chapter 12A for the purpose of its income tax impact. Are you all listening? Now let's understand what is the next section. So 115C is all about the definitions. I hope it is clear. NRI, investment income or long-term capital gain from foreign exchange asset. What is foreign exchange asset? An asset, specified asset which is purchased in foreign currency. What is specified asset? Shares of an Indian company, debentures of a public limited company, or deposits in a public limited company, any security of CG, or any other asset notified by CG, central government. Now, next is 115E. Let's understand what is 115E. 115E talks about rate of taxes. 115E talks about rate of taxes. First of all, let's understand about investment income. In the case of an investment income, it is taxed at what rate? 20% plus surcharge if any plus 4% cess. If an NRI have some investment income, then the NRI should pay taxes at what rate, friends? 20% plus applicable surcharge and 4% cess on that investment income. That's what the department says. Are you all with me? If an NRI has investment income, then that investment income is taxed at flat rate of 20% under section 115E. How about long-term capital gain? Long-term capital gain is also rate shall be provided under 115E. Tax rate under section 115E on long-term capital gain of such assets. What is the rate? Right now there are two rates. Long-term capital gain from transfer of specified assets. 10% if the transfer is before 23rd July 2024. If those assets are getting transferred before 23rd July 2024, rate of tax 10%. After 23rd July 2024, on or after 23rd July 2024, 12.5%, because they have uniformly aligned all the rates. Right now, normal long-term capital gain is 12.5. This long-term capital gain is also 12.5 plus surcharge if any plus 4% cess. Are you with me? So for this attempt, it is always better to study both the rates, because depends upon the date of transfer. It can be either 10 or 12.5. Are you all with me? So depends upon the date of transfer, either 10% or 12.5%. That's what the department says. Now friends, listen. So for investment income, 115E says that the rate is 20%, and for long-term capital gain, it is either 10 or 12.5, depends upon the date of transfer. If it is before 23rd July, 10. On or after, 12.5. Now, listen. So that is all about 115C. 115D talks about certain conditions while computing the income. Certain expenses not deductible and certain other conditions that you have to follow while computing the gain or computing the investment income. So let's understand what is 115D. What is 115D? 115D is special provision. What is that? No deduction on any expenses while computing the investment income. No deduction on any expense while computing investment income. Correct that. Okay. While computing investment income, you are not supposed to claim any expenses as deduction. It is taxed at flat 20%. What is flat? Whatever the dividend, whatever the interest, tax at 20%. Don't claim any expenses as a deduction. No chapter 6A deduction from both. Both means what? There are two incomes under this chapter. From long-term capital gain as well as from investment income, you cannot claim any chapter 6A deduction. Not permissible. And no indexation from long-term capital gain. From long-term capital gain, you cannot claim any indexation. Whether the transfer is before 23rd July or after 23rd July doesn't matter. You cannot claim any indexation benefit. Now listen. To end up all the confusions, I have given a detailed chart under. Okay, expenditures, investment income, long-term capital gain. Can you claim expenditures from investment income? No. Can you claim expenditures from long-term capital gain? Yes, you can claim direct expenses on transfer and cost of acquisition from long-term capital gain. It is permissible. They are only restricting expenses from investment income, not from long-term capital gain. First proviso to section 48, conversion, reconversion. Investment income, it is not applicable. But long-term capital gain, it is allowable. If the is an NRI means NR. A foreign exchange asset means purchasing assets in foreign currency. If it is shares of an Indian company or debentures of a company, Indian company, then you must follow first proviso to section 48 as well. That means conversion and reconversion as well. Are you with me? Then, second proviso to section 48, indexation. For investment income, it's not applicable. For long-term capital gain, not allowable. Chapter 6A reduction, not allowable, not allowable. Are you with me? So this is how you should understand section 115D. So it talks about conditions. Now, moving on to the next one. Next, as per the order, is 115F. Let's understand what is 115F. Do you remember, maybe for your inter, under capital gain, you might have studied a section called 54, exemption. What is that? You sell a residential house property and you are buying a residential house property, then you will get that purchase cost of the new residential house property as an exemption from transfer of old residential house property. Have you studied this? Sell old, buy new. You will get an exemption under 54. Likewise, that residential house property and this section have no connection. Likewise, the concept is similar. You sell a foreign exchange asset and you buy another specified asset, you will get an exemption under 115F. You sell a foreign exchange asset and you buy another specified asset, you will get an exemption under 115F on satisfaction of the conditions that we are about to discuss right now. So, exemption under section 115F. Let's understand what exactly is that exemption. Listen friends. What they are saying is, where an NRI has transferred a long-term foreign exchange asset and within a period of how many months? 6 months after the date of transfer, invested the net consideration in specified asset, then exemption is as follows. If you have transferred a specified asset, a foreign exchange asset, and you have invested within 6 months from the date of transfer in another specified asset, then you can claim exemption, which are as follows. How do you compute that exemption? What department say? Long-term capital gain into amount invested in new asset divided by net sale consideration. We will rewrite that. How do you compute exemption? Under section 115F, exemption shall be long-term capital gain into amount invested in new asset divided by net sale consideration. So this is the formula. Now for the time being, think only about this fraction of the formula. What do you mean by this fraction? Out of net sale consideration on sale of foreign exchange asset, how much you have invested in the new assets? So now that is the meaning of that fraction. Out of NSC, how much you are investing in the new specified asset. That percentage on long-term capital gain is your exemption. That simply means you are investing all the net sale consideration in new asset. You will get 100% long-term capital gain as exemption. If you are investing only 50% of the net sale consideration in the new asset, you will only get 50% of long-term capital gain as an exemption. So how much ever is your investment in the new asset compared to the NSC, that percentage on long-term capital gain shall be your exemption under 115F. Are you with me? So moving on to the point, long-term capital gain into amount invested in the new asset divided by net sale consideration. Now friends, another condition is there. So what department is saying, you are not withdrawing the profit, rather than you are reinvesting. You are what? Reinvesting in the same asset. We don't want to tax that reinvestments. That is what 115F is all about. Are you with me? But if you are purchasing a new specified asset, then there is a condition that for the next 3 years, you are not supposed to sell that particular shares or assets or debentures, whatever it is. If you are purchasing specified assets which is there in this blue box, and you have to satisfy a condition, what is that condition? For the next upcoming 3 years, you are not supposed to transfer that particular new shares. You are not supposed to transfer that particular new shares for how many years? Upcoming 3 years, you are not supposed to transfer that shares. You have to maintain that shares with you. Are you with me? What if you don't satisfy that lock-in period condition? What if there's a premature transfer? What do you mean by premature transfer? Before 3 years, you are transferring that particular asset. In such a case, benefit availed earlier during this section shall be taxed as long-term capital gain in the previous year in which such asset is transferred or converted into money. That simply means if you are violating that particular that lock-in period condition, in the year of violation, you do one thing, you take that exempted amount earlier, that exemption that you got earlier as a taxable income. You reverse the effect. We have given you an exemption based on a condition that you will not sell that particular new asset for another 3 years. Now this year, if you are violating that condition, do one thing, the exemption claimed earlier have to be treated as your deemed long-term capital gain in the year of violation. You reverse the effect. That's what they are saying. Are you with me? Now friends, moving on with the next one, the next advantage, if there is no other income other than investment income and long-term capital gain under this section, plus TDS has been correctly deducted, then the assessees are not required to file return of income. Say for example, if these persons does not have any other income apart from long-term capital gain and investment income, plus when they receive that income, TDS has been correctly deducted. Don't worry, you don't have to file return of income. But if you have any other income in India, you have to file return by including this also. Are you with me? Now, what is the objective of this chapter 12A? See, government is indirectly telling to all the NRIs, you are earning income overseas. You do one thing, you invest that money in India. We want your investments to come back to India. But when you invest, you will be having certain concerns. Most probably, if you are a non-resident, you will be having a comparatively higher salary. Most probably, your salary may be about 15 lakhs or 10 lakhs. So that for normal income, if you are earning some income in India, effectively, maybe you are rich. Okay, I'm not saying that all persons will be having more than 10 lakh or 15 lakh from India, but still, the highest rate of tax for an income in India is 30%. You do one thing, you are investing those money into India and earning some investment income, you pay as tax only 20%. Then, if you are having long-term capital gain, you pay as tax only 12.5%. Are you with me? Now, the next question that will come to your mind is, when you are having no other income, say you only have this income, and you've invested in these assets, you have to simply file return in India and you have to follow all the compliances. Don't worry. The person who is about to give you the money will deduct the TDS. Thereafter, you don't have to file any return. You don't have to follow any legal consequences. Are you with me? You don't have any headache at all. The person who is about to give you that money will deduct the TDS. If you don't have any other income, don't worry about filing your return. Another advantage, you purchase some shares. You want to sell the shares and reinvest in the specified asset. Do it. You increase your wealth. You don't have to pay taxes for increasing that wealth. That's why 115F is there. You withdraw the money rather than reinvesting it, then you have to pay the taxes. If you are selling and buying shares, no problem, we have no plans to tax you. Or if you are selling and buying securities, no problem, we have no plans to tax you. You keep on trade, keep on increase your wealth, don't pay us taxes. Are you with me? So 115F is really crucial. Why? Because you can increase your wealth without paying the taxes. Have you understood what I am saying? Now, lot of offers are given to the assessee. So the last offer was 115G. So we have completed till 115G. Now, after all these things, you will be having another concern. What is the another concern? Say for example, at the time of investment, you were an NRI. Thereafter, you lost your job or you resigned from your job. You are planning to come back to India. So at the time of investment, you were an NRI. Now you are coming to India and planning to reside in India. So eventually you will become resident. Yes or no? If you become resident, can you claim these benefits? Department say, don't worry. After becoming, at the time of investment, you were an NRI. Now you become a resident. You can still continue this benefits. For that, what you need to do, where a person who is an NRI becomes assessable as resident in subsequent year, they may furnish a declaration to continue to the applicability of the above provision. They are not saying you have to get an approval. They are simply saying submit a declaration, a statement, and stating that you want to continue these benefits. More than enough. If it does so, investment income alone shall be taxed under this provision until the transfer or conversion into money of such asset. If you are giving such a declaration, your investment income in future is going to be taxable at 20%. If you sell it, a long-term capital gain will be not applicable, because when you are selling it right now, you are a resident. So these provisions are not applicable, because when you are selling it, you are quitting from the rate. You have investment income, okay, no problem. We will still tax that investment income at 20% as per 115E only. Are you with me? After all these things you are saying, these provisions are not good for me. You are saying that these provisions are not good for me. Say your interest income is only 2,50,000. Okay, if your interest income is only 2,50,000, you can enjoy basic exemption limit. And you wouldn't want to pay tax at 20%. Or say your investment income is only 5 lakh. Then you can claim what? 2 points, not rebate. Here you are an NRI. You cannot claim any rebate. Say your investment income is only 5 lakh. You can pay taxes at only 5% as per the slab rate. Don't worry. If you think that these provisions are not good for you, you opt out from this. We are not saying that you have to mandatorily follow this provision. That is 115I. What are they saying? Non-applicability of the above provision. An assessee may elect not to be governed by this provision for any AY. If he does so, the provisions of this chapter shall not apply to him. Don't worry. If you think that these provisions are not good for you, you opt out. You simply opt out. We are not mandating that you have to follow these provisions. Are you with me? So there is a specific provision to opt out. That is 115I. H was declaration, I is opt out. Are you with me? But in examination, you must follow this provision. If it is an NRI, investment income, long-term capital gain, don't write an assumption. I am opting out because I haven't studied CDEFGHI. Don't say like that. You must follow. If the question say opting out, then opt out. Otherwise, you must follow CDEFGHI. Are you with me? In examination, if all the conditions are satisfied, then you must follow this chapter 12A, which is applicable to NRIs. I hope you got an understanding over this topic. Yes, so this is how you have to compute chapter 12A, that is certain set of incomes, investment income, long-term capital gain, etc. applicable for a NRI. Now it's time for us to solve some questions in relation to this particular topic. So we'll start with we'll solve two questions. We have actually two questions. So please take question number 5 and solve it. Easy question. Okay, question number 5. Go through that question and give me the answer, friends. So friends, let's solve the answer together. A non-resident Indian acquired shares on 1/1/2010 for 1 lakh in foreign currency. These shares are sold by him on 1/1/2025 for 3 lakh. So the question clearly says that non-resident Indian, and he acquired shares for 1 lakh in foreign currency. So there is shares which is purchased in foreign currency and he is a non-resident Indian. So you must solve the question in accordance with chapter 12a. So what is the full value consideration? Full value consideration of that share is rupees 3 lakh. He sold it for 3 lakh on 1125. And what is the cost of acquisition? 1 lakh. Can you claim indexation? No ways. How much will be the capital gain? That too long-term capital gain because purchased in 2010, sold in 2025. So you tell me what is the long-term capital gain figure? 2 lakh. Now they have invested that consideration in shares on 31st March 2025. So within 6 months time they have invested. So you can claim exemption under section 115F. How do you claim exemption? Out of net sale consideration of 3 lakh. Here there is no direct expenses, so full value consideration itself is the net sale consideration. How much you have invested in the new asset? Investment in new asset is 3 lakh. Into long term capital gain is your exemption. That is the entire 2 lakh you can claim as exemption. And hence nothing shall be taxable as capital gain. Are you with me? So are they saying anything else? These shares are sold by him on 36/2025. So this will be for the year 24-25. Now he sold that particular shares in the previous year 2025-26. So first of all, when he's selling that, you need to compute capital gain for that share sales. That is a short-term capital gain. And what is the value of sale? 3,50,000. You can take cost of acquisition as 3 lakh. So short-term capital gain would be obviously 50,000. Your short-term capital gain as per that question will be 50,000. 50,000 STCG. Not yet over. Since there is a violation of lock-in period condition, the exemption that you have claimed earlier shall become your long-term capital gain, and that will be rupees 2 lakh. So short-term capital gain 50, long-term capital gain 2 lakh. This should be your final answer. Are you with me? Short-term capital gain taxable at normal rates and long-term capital gain accordance with 12.5%, and that should be, they are not asking the rate of tax, but that should be the rate of tax. Yeah. So that's how you have to write the answer. I hope it is clear. Now, one more thing should have been done over there. What is that? See, since he is a non-resident and purchased the shares in foreign currency, you have to do that first proviso to section 48, conversion, reconversion. But in the question, they are clearly saying that conversion into reconversion. First proviso to section 48, you can ignore. If it is not there, then they will give TTBR and TTSR. You convert everything into foreign currency and you reconvert it into Indian rupee, then claim the 115F exemption. This is what you are supposed to do. Are you with me? But the questioner says, don't do or don't follow first proviso to section 48. If they don't want, we also don't want. That's it. Second question. So take question number 6 and give me the answer. Take question number 6, go through it and give me the answer. So let's solve question number 6 as well. Mr. John, a non-resident Indian, purchased shares of an Indian company at a cost of 70,000 in 2012 in foreign currency. So we know that it will be under chapter 12A because NRI, shares of an Indian company, purchased in foreign currency, everything matching. Mr. John sold the shares for consideration of 2,50,000 on 1/8/2024. Expenditure incurred wholly and exclusively in connection with the transfer is 10,000. So we have full value consideration as well as direct expenses on transfer. So we will write full value consideration first. How much is the full value consideration as per the question, friends? It is 2,50,000. And direct expenses on transfer is how much? Say 10,000. And hence how much is the net sale consideration? 2,40,000 is the net sale consideration. So is there any cost of acquisition? Yes. In 2010, they purchased it for 1 lakh. and you cannot claim the benefit of indexation. So the taxable gain will be 1,40,000. Now, what they have done is, sorry, not 1,70,000, right? The cost of acquisition is only 70,000. 1 lakh is the cost of acquisition of last question, okay? 70,000. And how much will be the long-term capital gain? 1,70,000 should be the long-term capital gain. Now, friends, listen. Compute the capital gain if you have deposited in specified asset 1,50,000 out of sale consideration. So, 115F exemption, let's compute. How do you compute 115F? Out of net sale consideration of 2,40,000, how much you have invested in the new asset? What is the investment in new asset? 1,50,000 into long-term capital gain of 1,70,000. Can you tell me how much will be the 1,06,250 shall be the exemption. 1,06,250 you can claim as exemption. And how much will be the taxable long-term capital gain? 63,750 shall be the taxable LTCG. And I hope it is clear for you. Are you all with me? Super.